It's time for your weekly financial workout with your elite personal trainers, Ryan and Bob Payne, guiding you on how to build a stronger and more robust financial plan. So get ready. We're about to pump you up. Live from the greatest city in the world, this is No Payne, No Gain.
Good morning. It's No Payne, No Gain Financial Radio. I'm your host, Ryan Payne, President of Payne Capital Management, along with Chief Investment Officer, the man with a plan, my father, Big Bob Payne. Good morning, Bob. Good morning, Dad. How you doing this morning?
I'm doing well, Rye. I can't believe I already have the dog days of summer here in July. It felt like August this week.
Yeah, I mean, the heat was definitely on, but I'll tell you what, I'm a man who enjoys the heat more than the cold. I don't care how hot it gets. I won't complain, because when it's 20 degrees and I'm walking to the subway, I'm not going to be a happy camper. So I'll take the dog days of summer, Bob.
I was wondering why you had such a big smile on your face today.
There you go. There you go. The secret's out.
All
well,
right.
We got a big show this morning, as always, to help you on your path to financial freedom. We're going to talk about problem solving. You know, what pitfalls you could potentially face when it comes to handling your finances and how to solve those problems. And we're going to look at the wrong questions. You know, what retirement planning questions you're asking as opposed to ones you should really be asking. So we're going to break that down for you, along with this week's financial pornography, what's going out there in the media that you need to stay away from, and of course our spotlight segment, where we're going to take a real financial plan, we're going to dissect it, show you what mistakes were made so you can stay clear of those mistakes with your own planning. So let's hop to it. Problem solving. Let's face it, when you're working with a financial advisor, their primary job isn't just to pick investments for you. That's really only one component of what they should be doing. There's a lot of issues that need to be resolved when it comes to designing your wealth plan. And one that I think about that's huge is tax-related issues. There's always issues when it comes to taxes and your financial plan.
Well, there's a lot of issues when you have a plan and you have a long-time relationship with a planner. Sometimes you take each other for granted, right? They take you for granted and assuming that the advice they gave you 40 years ago still holds to this day. And you assume that since no one's telling you to do anything different, that everything's okay. And I find this really happens a lot with the total financial master plan when you look at estate planning, tax planning, and investment planning, but especially with investments. We had a woman a couple of months ago that we brought in, Rye, who had all of her money, I mean, millions of dollars invested in treasury bonds. Now, that doesn't sound like a bad deal, does it?
Well, I mean, the one thing that comes to mind is treasury bonds, which are issued by the U.S. government. It's a loan to the U.S. government, so it's very safe. But the interest rates are lousy. You're getting like 1% right now in treasuries, which, let's face it, that's a lousy yield to achieve on your investments.
Now, for this poor woman, because her advisor believed that they were good, safe investments, and wasn't always treasury bonds, most of it was treasury bills, and she was getting that horrible return for 6 years because she was basically losing money because of inflation. Now, let's just say I called you today, Rye, said, hey, I got a deal, I got an offer you can't refuse. I've got an investment that's guaranteed by the U.S. government, and you're going to get a negative return, not just this year, but for the next 8 years. Would you sign up for that?
I think I would think long and hard, and I think I would politely decline, which is a good point, Bob, because let's face it, I mean, inflation hasn't been that high, but the cost of living has been going up by, closer to maybe, 2% a year. And if the cost of living is going up by 2% a year and you're achieving 1% on your investments, to your point, even though your money is growing a little bit, you're actually losing against what things cost today from what they did 8 years ago. And prices have definitely gone up in the last 8 years. I mean, just go to the grocery store.
Well, the nice thing about problems, right, there are easy solutions. In this case, we were able to take this portfolio of AA rated treasuries, because U.S. government treasury bonds are now AA rated, and we were able to move them into AA rated tax-free municipal bonds. We were able to sometimes double and even in some cases triple her yield, and it was now all tax-free. And instead of having a negative return every year, she now has a positive tax-free return that she can live on. So very simple solution. But that wasn't the end of her problems. She also had a portfolio of high-quality dividend-paying stocks, and her stockbroker decided to increase the yield by writing covered calls. Do you know what they're all about?
Yeah, so basically, and you may hear this term, a covered call strategy, as an income strategy. So if you have a portfolio of stocks that you own, you can essentially put a contract on top of your stock that gives another investor the right to buy the stock from you at a certain price. And to do that, they pay you a premium. So if you own Coca-Cola stock, let's say, and basically you can earn a premium on top of that by giving another investor the right to buy that at a certain price. So we call that a covered call strategy, which basically is to generate income, which sounds like a very good strategy at face value, Bob.
Well, it sounds like a great strategy until you got to pay your taxes. Because first of all, every dollar of premium that you generate from writing a call option or selling the right to sell your stock to somebody else, that's cash that goes immediately into your account. That's a good thing. Bad thing is it's ordinary income. Even if it's a 1 year or 2 year option, it's all ordinary income, which pushed this poor woman into a higher tax bracket. Now, the other negative is if the stock goes up, and the last I checked, we've been in this big booming bull market this year, you get called out of the stock. In other words, you're forced to sell a stock that you had intentions of holding on for the rest of your life. Now you got more taxes to pay. So this poor woman had all the money she needed to achieve lifetime income without the chance of ever running out. And she's paying 2-3 times the amount of tax she needed to pay simply because her financial advisor, her stockbroker, is following the same strategy today that he started following 40 years ago.
Yeah, and I think that goes back to when it comes to your investment portfolio, and this is why taxes are so critical, it's not what you make, but it's what you actually put in your pocket after taxes. And that covered call strategy is a great example because you could earn a lot of income and achieve a high rate of return on your investment, but once you paid all the taxes on it, you may end up with a very low return on your investment, where conversely, Bob, like you were saying, you bought this woman tax-free or municipal bonds. The return on those is relatively low. Let's call it 3-4% current yield. But because it's tax-free, in this case, she ended up with a better return after tax than the higher return strategy that she had to pay a lot of taxes on. So that's why we talk about this ad nauseum, but looking at tax efficiency on your portfolio has a lot to do with how much money you can live on in retirement. And if you're thinking right now, I have no idea what kind of taxes I'm paying on my portfolio. Is my portfolio tax efficient or tax inefficient? Here's your shot to do it. If you're one of the next 10 callers and you have over $200,000 saved for retirement, Bob and I will run for you our total financial master plan with no obligation or cost. That's a full review that addresses everything. So if you bring in last year's tax return, we will actually have our CPA partner review it to make sure you're not paying unnecessary taxes and you're optimizing your portfolio so you have more money going in your pocket as opposed to the government's pocket. We're going to look at estate planning. If you bring in your wills, your trusts, we have an estate planner that will review that to make sure that your estate plan is up to date, what changes you may want to make. And then finally, bring in all your financial statements, 401ks, IRAs, insurance policies, annuities, brokerage accounts. We're going to consolidate it into one simple 3-page spreadsheet, our investment analysis spreadsheet, and we're going to look at every aspect of your portfolio. We're going to look at fees. Are you being overcharged on your investments? We're going to break down all the costs, including those hidden costs you don't know you're paying. We're going to look at income. Can you increase the cash flow or income on your portfolio? Income is critical in retirement. Bob and I are going to show you how to optimize it, and we're going to look at diversification. Is your portfolio overweighted, underweighted? We're going to show you what pitfalls you have, what risks you have in your portfolio. Then we're going to tie it all together into a total financial master plan to determine, are you going to outlive your money or is your money going to outlive you, utilizing strategies our family has worked on for literally 40 years to take your family from point A to point B with the least amount of risk and the highest odds of success.
So call us at 844-PLAN-NYC, 844-752-6692. If you're one of the next 10 callers with over $200,000 saved for retirement, our team at Payne Capital Management will run for you our total financial master plan. There's no obligation. There's no cost. Just give us a call. 844-PLAN-NYC. That's 844-752-6692. This is Bob and Rye at No Payne, No Gain Financial Radio.
It's time for the weekly No Payne, No Gain market update with the team at Payne Capital Management here in New York City.
Good morning. This is Bob Payne, Chief Investment Officer here at Payne Capital Management. And comments from the Federal Reserve and positive earnings reports from the banking industry drove the markets to all-time record highs on the week. Now on Wednesday, Federal Reserve Chairwoman Janet Yellen, affectionately known here at Payne Capital Management as Aunt Janet, said the U.S. economy should continue to expand, and allowing the central banks to keep raising rates, but also stressing that the Fed is monitoring what they call too low inflation. Now, while the economy's largely performed in line with the central bank's forecast, inflation has been weaker than expected over the last 5 years. Now, excluding volatile food and energy categories, the Fed's preferred inflation gauge slowed to a gain of 1.4% over the year. That's versus 1.8% just this past February. Now, the Fed has fallen short of its 2% inflation target for most of the past 5 years. Now, Aunt Janet pointed to the low unemployment rate, which, in all fairness, traditionally would point to rising wages. But she said, quote, "We're not seeing very substantial upward pressure on wages, but we may begin to see upward pressure on wages and prices." Of course, this is the same old singer and the same old song from the Fed that we've been hearing for how many years? Well, the most important thing that was said, as far as the markets were concerned, was that the reduction of the huge $4.5 trillion balance sheet and the subsequent rate increases that the Fed spoke about are going to be gradual. Now, this was perceived as a much more dovish stance on the part of the Fed and really took away one of the stock market's primary worries, which was the Fed would raise rates regardless of the health of the economy. In other words, Aunt Janet set expectations for an easier Fed policy as real economic growth improves. I guess this is their way of saying the Fed's got our back. So let's summarize. We got economic growth, we got low inflation, we got interest rates lower for longer, and we have an accommodative Fed that has our back. That's a combination that risk assets absolutely adore. And of course, the biggest winners on the week were growth stocks and emerging markets. Now, all these indices, growth indices and emerging market indices, are heavily weighted towards technology, and technology stocks are big beneficiaries of low interest rates. So let's look at the emerging market index. Hit another 52-week high for a rise of 3.6% for the month and is now up, and our biggest winner, 20% for the year in 2017. Now, if you're thinking and wondering, do I have a portfolio that's positioned for a much more accommodative Federal Reserve? Why sit there and wonder when you could know? Give us a call at 844-PLAN-NYC. That's 844-752-6692. This is Bob Payne of No Payne, No Gain Financial Radio.
For all the latest information and news that you need to retire successfully, make sure you go to BeBullish.com. That's BeBullish.com.
It's Ryan Payne, Bob Payne, No Pain, No Gain. In this segment, we want to discuss wrong questions. You most likely have a lot of questions about your retirement plan, and Bob and I have found that you're often asking the wrong questions. So Bob, let's discuss some of these common questions that you might be asking and why you should be asking a different question. And one of them that comes to mind for me is, how much money do I need to have saved in order to retire?
Well, I got a better question, Ryan. It might be, how much income will I need or how much total return will I need? But more importantly, the real question is, why do I need to have money, right? Because a lot of people invest for one reason, and that's to make money. And making money is not a goal. Now, what are some of the great goals of life, Ryan?
Well, we talk about the 4 Ps, which would be, actually, what are the 4 Ps, Bob?
All right, it's not the 4 Ps. But anyway, a lot of people, when you think about investing, they think about making money. Now, making money is not a goal. What you need to know is, why do you need to make money? Well, in most cases, it comes down to what I call the great goals of life. Having a lifetime of income you can't outlive, educating your children and your grandchildren, gifting money, to your cherished institution or favorite charity, and most importantly, passing on that wealth that you've created, to your heirs and to your cherished institutions with the least amount of government partnership. So really, what you have to do is you have to start at the beginning. And we have a process that, Ra, you and I have perfected now over 40 years called the ADB process. And,
That's right.
How do you get started with that?
Well, I think the thing is, a good point, right? It's not about making money, but it's working back from your goals. So, you've coined the phrase a long time ago called the A to B process. And A to B is just clearly, I'm at point A, I'm trying to get to point B. And what I like about that, and I think with any advisor you're working with or anytime you're putting together a financial plan, you always have to work back from point B, right? You got to start to paint a picture of where the heck am I trying to go? And that's what you can call a lot of different things. We call them wealth projections at our firm. You can call them a financial plan. But some way you got to start to look at, okay, what are my monthly expenses going to look like once I inflate those, because things are going to cost more in the future? What are taxes potentially going to look like? What about those pesky RMDs? At some point, you're going to have to take money out of your retirement account. The government's going to force you to do it. What impact is that going to have on my portfolio? And just a myriad of different things that are going to happen. When do I take Social Security? So, really painting a picture, Bob, of what all those things look like. That's kind of point B. And until you have that picture painted, it's really hard to build any sort of investment plan, in our experience.
So I guess what it really comes down to, right, is you got to ask the right question. It's like, how much money do I need to have saved in order to retire? You have to work, with the end in mind. Why do I need my money to grow? And then once you know what those goals are, you can simply work backwards, right, and figure what rate of return you need to achieve. How much of that should be dividend and income? How much of that should be capital gains? Where does your passive income streams come in? A lot of times you think, well, I just want to be Warren Buffett, right? I want to invest and make a lot of money. But if you invest with Warren Buffett, he has a stock that doesn't pay a dividend. Well, what are you going to live on, when you're retired? You need cash flow, to supply you with the cash you need to survive. So it sounds like a simple thing. It can get very complex. But once you personalize it, it's pretty easy.
Yeah, exactly. Once you start with point B, it becomes really easy. Because the other question is, talking about I want to make a return on my money. Sometimes you'll hear things like, I want to get the highest return on my money. But, what, like to your point, Bob, what does that really mean? And the beauty of working back from your goals, you can actually figure out what returns you actually need on your money. Because that's more important than getting the highest return on my money. Because let's face it, and I think this goes back about 15, 20 years, they interviewed Shaquille O'Neal, and when he was in the prime of his basketball career, he was making a ton of money. And some sports commentator interviewed him and said, hey, Shaq, what are you doing with all that money that you're making right now? And he said, one word, T-bills. He said, T-bills, that's the most conservative investment on earth. Treasury, we were talking about that earlier in the show today. You earn like nothing on it. And he says, look, I've got more money. It doesn't matter if I get a return on my money or not. I'm set for life regardless. And I think that's a really good point, because why take more risk than you need? In Shaquille O'Neal's case, he didn't need money in the stock market. He had so much money that, based on his lifestyle, he wasn't going to need to, take unnecessary risk. And I think that's the one mistake you make with your portfolio, is taking unnecessary risk. And, if you don't need to take the risk, I always argue, why take it? Why not lock up a component of your portfolio in proverbial safe investments where you're going to get a return of principal? Because the market's a great place to invest long term, but I can't promise you in 4 years the Dow Jones is going to be at 25,000. I don't know what's going to be tomorrow, never mind 5 years from now.
Yeah, so right. It's such a good point, but, not everybody has Shaq money. So people do have to take some risk, but there's no reason to take unnecessary risk or more risk than you need to overcome inflation and achieve those goals.
Amen, Bob. And that's that's like the holy grail there to some extent on when you're building your investment portfolio. Another question I think is the wrong question to ask is, where can I pay the lowest fees for financial advice?
Well, you know what, Rye, it's pretty interesting. When you look at fees, it's not just about the fees that you see, it's also the fees that are hidden. And it's really about how your advisor or your stockbroker is compensated. When I was back in the wirehouse days, we had people in our office we called transaction junkies. Now, they were junkies because they lived to do transactions, and they were basically commission-driven brokers. Now, that means people had to do something in their portfolio every day for them to eat. And the problem is, when you come to a situation where the client has a perfect portfolio, the market's doing really well like it is right now, there's not necessarily a need to do a transaction. But let me give you an example. Do you remember what happened to the market back in 1973, 74?
I'm going to be honest with you, Bob. I don't recollect, given I was not born yet.
You weren't born yet, but I can tell you, it was the most horrific bear market and we didn't see anything quite like it until 2000. But in 73, 74, market seemed like it went down every day. And people, they're losing money every day in their portfolio. So if you're an advisor and you're advising somebody to invest for life, but they're a transaction junkie, and they call you up and say, hey, I can't take it anymore, sell me out. Now, if you're a good advisor, the worst thing you can do is sell at the bottom of a bear market. Of course, you don't know where the bottom is, but you can feel it when you're pretty close. But if you're sitting there saying, okay, if I let this client panic out, I'll be able to make my mortgage payment. But if I tell them to do the right thing, I'm probably going to be unemployed next week. That's just too much pressure for any human being to sustain. And you know what happened. The transaction junkie always did the wrong thing and did what was best for them, not what was best for the client. So you've got to look at how your advisor is compensated. And I believe that a fee that compensates an advisor as a fiduciary, where they have to find the least expensive investments with the highest probability of success, is really the best way to pay the lowest possible cost and get the highest possible return as an investor.
Yeah, exactly right. It's kind of like if you're going to get surgery, you want to go to one of the best surgeons. You want to know that they're getting compensated fairly because you don't want someone doing something for free if it's your financial health that's at risk or your physical health at risk. And that's why it's so critical. I think the first question you want to ask your advisor or interviewing advisor is clearly, are you a fiduciary?
Here's the nice clue to find out whether or not you're overpaying for your investments. Take a look at your statement. If you have investments that have symbols that have 4 or 5 letters, you've got more in cost than you probably need. So start there. Now, what we'd like to offer anyone else who doesn't have time to look at their statements, and if you're one of the next 10 callers and you've saved at least $200,000 for retirement, Ryan and I will run for you our renowned Total Financial Master Plan. Now, there's no obligation and there's no cost. And if you're one of the lucky next few callers, here's exactly what you can expect. We're going to review your tax return. Not us, our CPA partner is going to look at this year and last year's tax return to make sure that you're utilizing every tax benefit that's legally available to you. We're going to review your estate plan. We're going to look at your will. We're going to look at your trust. We're going to look at your beneficiaries and see how they're stated to make sure that your money goes to who you intend it to go to, once those legal documents are necessary. And lastly, we're going to review all of your investment statements, whether you're using an insurance company or a bank or a brokerage firm. We're going to look at all of those statements and we're going to reduce it down to our famous 3-page, simple investment analysis spreadsheet. We're going to see if you're truly diversified. We're going to look at your fees and reveal behind the curtain what you're paying, both in fees and hidden fees on your total portfolio. And lastly, we're going to look and see if we can optimize more income for the investments that you have to make sure that your portfolio is producing the cash flow that you need to achieve your goals. And lastly, we'll tie it all together into one customized Total Financial Master Plan, utilizing strategies that my son and I have now been working on for 4 decades. That's 42 years. We want to help take you from your point A to point B with the least amount of risk and the highest odds of success.
So don't waste time. Give us a call at 844-PLAN-NYC. That's 844-752-6692. Be one of the next 10 callers. Get the full review at 844-PLAN-NYC. That's 844-752-6692. We're going to look at everything at 844-PLAN-NYC. This is No Payne, No Gain Financial Radio.
With a constantly changing financial landscape, having a written, customized plan is more important than ever. In New York City, turn to the team at Payne Capital Management. Call 844-PLAN-NYC to schedule a complimentary financial review. That's 844-PLAN-NYC.
It's time for Financial Pornography of the Week. This is where Bob and I scour the daily financial news and call out the biggest offenders of offering obscene and profane financial guidance to help you protect yourself from making any ill-advised financial decisions. And Bob, I think this week, really we found something that was kind of anti-financial pornography, a research report that you actually sent out to me. Richard Bernstein, who for a long time was at Merrill Lynch and someone we follow very closely, came up with what we call the 3 Ps. He talked about politics, ignore it. Profits, critical to analyze, and probabilities, dispassionately assess. So why don't we start from the top? When he talked about politics, why ignore politics when it comes to investing?
Well, if you go all through history, politics are always the same. I just finished John Adams' biography. It's a terrific book, by the way, if anybody's looking for a good summer read. And the first president of the United States was George Washington. And he didn't want to run for a second term because he was so upset with the way the press criticized him on a daily basis. So things don't ever change. And when it comes to investing, the last thing you do is let your political thoughts influence your investment thinking. And the point that Rich makes in his piece is that whether you like President Obama or you like President Trump or you dislike President Trump and dislike President Obama, guess what happened under President Obama, Rye?
Market went up for 8 years in really one of the greatest bull markets of all time.
Yeah, so we've had a terrific 8-year bull market under President Obama, and I don't think he cares whether you like him or not. The market certainly didn't. And so far, under President Trump, guess what's happening in the market?
I take a wild guess, Bob, since I watch the market every day. It's up.
It's up. Amazing, right? So bull market continues. It doesn't matter who sits in the White House. The other two Ps are what's important. But he makes a really good point. When you think about political upheaval and, the biggest concern that the world has today, you got to think of North Korea. Well, you would think the South Koreans are sitting there, they're just shaking in their boots. They're digging out their bunkers, getting ready for a nuclear war. Guess what happened to the Korean stock market so far this year?
Yeah, and this surprised me. South Korea stock market for the first half of the year is up over 25%, one of the best markets in the world, which you would think seems so counterintuitive given all the risk right now geopolitically concentrated in that part of the world. And there, North Korea's neighbor has literally one of the best returns in the entire world right now.
Yeah, because I think it's so well said. When it comes to politics, it's about what things should be. What really matters is profits, and that's what really drives the markets. And the South Korean economy is making great profit. So the second P is what he says is most important. It's critical to understand where we are, not just in the economic cycle, but in the profit cycle. One of the things that I taught you early on about investing, Rye, was the PE ratio, right? Remember, there's no P without E. Now, what's that all mean? Well, P stands for price. So the price of an investment doesn't go up unless the underlying profits, which are what we call earnings, go up. So you should keep this in mind, that stocks are the slaves of earning power. Basically, if you don't have profits, you don't have profits in the stock market. So companies need to make money in order for those stocks to go up. And what Rich points out in this piece is that we are in a booming profit cycle, not just here, but globally, as indicated by what's happening in the South Korean stock market, for example.
Yeah, and I think that's the biggest misconception right now. There's a consensus out there thinking, well, this market keeps hitting new highs. It just must be very speculative. We must be in a bubble. But I think going back to the fact that what you just said, Bob, stocks are a slave to earnings, what everyone's missing is corporate profits are the largest portion of U.S. GDP in the history of this bull market. So, profits are at the greatest level they've ever been for U.S. companies, and that's really what drives the market long term.
So it kind of explains why we're at an all-time record high in the market this week.
Yeah, exactly. It's justified by earnings, not some sort of bubble that, you've been sitting there wondering, do I get into the market here? Do I take my profits here? Well, the reality of it is fundamentals are very, very strong right now, and profits continue to go up. The last P that Rich talks about are probabilities. Think realistically. What did Rich mean by that, Bob?
Well, there are a lot of things that I can tell you. Every meeting that I've had this week with our existing clients, everybody's so happy with the returns. They've been fantastic now with this big booming bull market, but nobody believes it. They're all very cautious and skeptical and, wondering about, when's the next shoe going to drop. So Rich talks about what are some of the probabilities or some of the black swan events or things that we're anticipating. The first thing was, is there going to be some fiscal stimulus, some economic stimulus coming out of the Trump administration?
Which we don't know, right? I mean, nothing seems to be able to get passed. So he thinks because, again, elections aren't that far off, that they're going to have to try to pass something along the way here somewhere. And if you look at history, the odds are, yes, some sort of stimulus package is probably going to come. Is it going to come in the next month or 6 months? I don't know. But most likely we're probably going to see some sort of fiscal stimulus from the Trump administration.
So that'll be a plus. That'll be like throwing gasoline on a fire. So the market should do better as a result of that. Now, the next probability was, What about the budget deficit? Will that get larger?
Sadly, yes. Sadly, yes. Yeah, these politicians can't help themselves, Bob.
Yeah, and that's a negative. So it's at some point, we're going to have to deal with that as a country and as a market. Now, the next probability, since we've had little or no growth in inflation, is inflation dead?
No. In fact, if you look at where interest rates were last year at this time, interest rates have actually been going up. Even though they've come down a little bit in the last couple months, the reality of it is the trend is most likely seeing interest rates go higher. And that's a really good point, because what happens is when interest rates go up, your bond prices go down. And if you look at it statistically, a lot of money's been going into what we don't like, Bob, bond funds, and often hedge funds as well. And the problem with those bond funds are, if interest rates continue to go higher, and remember, over the last year they have gone higher, those bond funds start to depreciate in price, and more than ever, probably a very, very dangerous time to be putting money into bond funds, or if you own bond funds right now.
So Rich poses the question, what's the probability that the mob is wrong?
Pretty high as always.
If you just do the opposite of what conventional wisdom is, I'll tell you, most times you're going to make money.
Yeah, and if you're sitting there thinking to yourself, I have to have a portfolio that takes advantage of the fact that there could be fiscal stimulus. Markets could continue to go higher here. I do have bond funds, and that can be a very risky place to be. Here's your shot to have the full review. If you're one of the next few callers and you have over $200,000 saved for retirement, Bob and I will run for you our total financial master plan with no obligation or cost. It's a full review. We're going to look at everything. That includes taxes. We'll have a CPA review last year's tax return to make sure you're not paying unnecessary taxes and optimizing your portfolio for taxes. If you bring in your estate docs, we have an estate planner that'll look at your wills, your trusts, make sure they're up to date and any changes you may want to make to your estate plan. And then finally, bring in all those investment statements, IRAs, 401ks, annuities, brokerage accounts. Bob and I are going to put it on a simple 3-page spreadsheet, our investment analysis spreadsheet, and we're going to look at everything. So we're going to look at fees. Are you being overcharged on your investments? We're going to break down all the fees, including those hidden costs you don't know you're paying. We're going to look at income. Can you increase the amount of income or cash flow your portfolio produces? Income's critical in retirement. We're going to show you how to optimize that. And we're going to look at diversification and risk. Do you own bond funds right now? Do you have money concentrated in one or two areas? Do you have pitfalls in your portfolio that you don't know you have? We're going to point out all the risk in your portfolio to help you avoid any kind of downturn in the future. Then we're going to tie it all together into one total financial master plan and determine, are you going to outlive your money, or is your money going to outlive you, using strategies we've literally worked on for 40 years to take you from point A to point B with the least amount of risk and the highest odds of success.
Hey, don't miss out on this opportunity. Give us a call at 844-PLAN-NYC. That's 844-752-6692. If you're one of the next few callers and you've saved over $200,000 for your retirement, we'll run for you our total financial master plan. No obligation, no cost, no strings attached. Just give us a call. 844-PLAN-NYC. 844-752-6692. This is Bob. This is Rye at No Payne No Gain Financial Radio.
Your personalized path to financial freedom awaits at Payne Capital Management. For more information, go to BeBullish.com. That's BeBullish.com.
It's Ryan Payne, Bob Payne, No Gain Financial Radio. And if you ever have a burning question you want to ask myself or Bob, you can email us. questions@BeBullish.com. That's questions@BeBullish.com. And if it's a really good question, Bob and I will answer that question right here on the show this morning. And as usual, we got a couple good questions, Bob. The first one comes in from Helen, who's in Long Island. She writes in, Bob, how much longer will this good run in the stock market last? Get your crystal ball out, Bob.
All right, Rye, have it all set up, and a little drum roll, Helen. Well, here it is. This is one thing you have to understand about this market. This is a bull market. More importantly, this is what we call a secular bull market, which tend to last a lot longer than normal uptrends in the stock market. So basically, attempting to call a top of a secular bull market is basically a fool's errand. Now, a lot of people think, well, it's been going up for a while. I just want to give you a little bit of history. Bull markets never die of old age. All right, we've had 13-year bull markets back in the 90s. We had a 13-year bull market in the 80s. We had a 15-year bull market in the 50s. We had a 14-year bull market in the 40s. When markets go up in a secular trend, they tend to go a lot further than anybody anticipates. So I think what we want to do is not think about, when will this bull market end, because there's inevitably going to be a correction somewhere down the line. But anyone who tried to time those usually fails. And I think the best way, and Ryan, maybe you can chime in on this, but I think the best way for Helen to invest in the market is to keep in mind that no matter how old you are, there's never been a permanent dip in the stock market in history since you've been alive, and that all dips are temporary. And since the market always goes up, don't you think Helen should stay fully invested based on a more conservative asset allocation?
Yeah, I think that's part of it. I'm going to take a step further. The other question to ask is, what market are you talking about? Because, yes, large cap U.S. stocks have had a magnificent run over the course of the last 8 years. But let's face it, foreign markets are just starting to go up. You look at things like commodities, they're actually in a bear market. They're going down. So, it's not just about, is my money in the market or not? Is your money diversified? Because different markets are going to work at different times. So you want to spread out your risk not only by U.S. companies or foreign companies, but we talk about size and style. So we talk about owning small cap stocks as well, mid cap stocks. So diversification is another key here. So you'll never ask yourself the question, when's the stock market going to go down? Because you're talking about, ideally, several markets in your portfolio.
Well said. Well said.
Next question comes in from Tom, and he's in Paramus, New Jersey. He writes in, Ryan and Bob, I'm constantly waffling between wanting to protect my money with safer investments and wanting to get as much growth as I can. What should I do? I'll be 60 next month. Sounds like he wants a very schizophrenic portfolio that works when the market's going up and gets the money out when the market's going down and protects himself. Well, there's no real perfect answer for this, Bob, in my opinion. It's really, again, we talked about this earlier in the show. It's about going from point A to point B. And again, point B is, Tom, what are your goals? What are you trying to achieve? How much growth do you need on your money? And then from there, you need to determine what return do I actually need on my portfolio, as opposed to how much growth can I possibly get right now.
It's so true, Ryan. I think when you look at the whole term of I want to protect my money, safe investment, nothing's safe from taxes, nothing's safe from inflation. And it's the cost of living that goes up. It doubles every 20 years. Whatever it costs you to live today, it's going to cost you double 20 years from now. You need your money to grow. So, I think poor Tom, he says he's waffling, and, Tom, you're a waffler, but it's not your fault. You're bombarded by the media, commercials about gold and silver and annuities and all these things that you're going to take all the risk away and give you all the reward. Well, it doesn't work that way. And, really, all you have to do is truly diversify your portfolio. And the only true way to hedge a great portfolio is to own high-quality bonds that mature. Because no matter what happens, you're going to get your money back and you're going to get to start all over again. So it's not about having the right investment. There's no perfect investment. Nobody ever rings the bell and tells you, here's the time to get in, here's the time to get out. You want to be a long-term smart investor, and a smart investor is one who diversifies, as Rye always says, across asset classes within asset classes.
That's right. So invariably what it's going to look like when you're building your portfolios, you're going to have both, right? You're going to have some money at risk for growth because you're going to need that. Even if you're retiring tomorrow and you're 60, 65, statistically, you could be in retirement for over 30 years. So that's a long time to have your money invested, or it's a long time you're going to need your money, so you're going to need a growth component. But the other side of that coin is you're now 60, 65. You can't take the same risk you could when you were in your peak working years, and if the market went down, you could just make it up because you're still earning money. So the whole idea is, and you hear this term a lot in our industry, it's you want an asset allocation. And that means that you're going to have a combination of safe monies, like you just mentioned, Bob, money and bonds that come due. Again, right now, more than ever, you got to be really careful with what kind of safe money you have in your portfolio. Because if you're looking at bond funds and you're looking at annuities, you're going to have the fees that go with that. The bond funds, they don't really have a lot of protection there, because if interest rates keep going up like they have for the last year, you're going to see your principal depreciate with no return of principal in sight. And if you own an annuity, you're going to have to give up your principal typically to earn some sort of income. So there's no free lunch there. So it's critical which way do you own your safe investments. And then conversely, you're going to have that money for growth, but how do you have that money diversified, right? You don't want to have all your money concentrated in one market. So when you're asking the question, is the market going to keep going up? You should say to yourself, what market is it and how many markets do I have in my portfolio? So I think having that combination, Bob, is the real critical or the secret sauce here. And how does that tie back into your goals?
Right, that's so well said, but I'm hearing all these different words: diversification, permanence and definition, bond funds, stocks, international stocks, growth and value. It can get very confusing. And you know what? Why be confused when you can have a written solution and a written analysis of what you're currently doing? So if you're one of the next few callers and you've saved at least $200,000 for retirement, give us a call. Ryan and I will run for you our renowned Total Financial Master Plan. There's no obligation. There's no cost. And if you're one of the next few callers, here's exactly what we're going to do for you. We're going to analyze your tax return, both this year's and last year's. Not us, our CPA partner, who's going to go through your return with a fine-tooth comb to make sure you're not paying any of those nasty, unnecessary taxes. We're going to review your legal documents. We're going to look over your will, your trust. If you haven't drawn them up yet, we're going to help you to get them done. 42% of Americans don't have a will, believe it or not. If you're one of those, give us a call. Lastly, we're going to review all of your investment statements. We're going to make sure that your portfolio is fully diversified across these different asset classes. We're going to show you the gaps in your current strategy. We're going to analyze your cost to see what it costs to maintain that portfolio on an annual basis, both the stated fees and those notorious hidden fees. And lastly, we're going to analyze the income. We're going to look at your cash flow. We're going to see if you can optimize more income from the current portfolio that you have. And finally, we're going to tie it all together into one customized Total Financial Master Plan. We're going to answer that age-old question: are you going to outlive your money, or is your money going to outlive you? We're going to help you by utilizing the strategies that we've perfected now for over 4 decades. Yes, we've been doing this for 40 years, and we want to help take your family from your personal point A to point B with the least amount of risk and the highest odds of success.
So don't waste time. Give us a call now at 844-PLAN-NYC. That's 844-752-6692. Be one of the next few callers to take advantage of this at 844-PLAN-NYC. That's 844-752-6692. This is the most comprehensive review on earth at 844-PLAN-NYC. That's 844-752-6692. This is No Pain, No Gain Financial Radio.
Here's this week's Spotlight on No Pain, No Gain.
Each week we dissect someone's real financial plan and uncover the flaws, or what we call pain points, that's P-A-Y-N-E, that a specific retiree or pre-retiree has, so you can avoid the same mistakes with your own planning and investing. And we do have a very special guest on the show today, my colleague, one of our star financial advisors here at Payne Capital Management, everyone's financial friend, Frankie Lagrateria. Good morning, Frank.
Good morning, Ryan. Welcome to Frankie's Financial Friends.
I think that that's going to be a show someday, and I'm gonna be one of your biggest fans.
It's gonna be a top show.
Well, you and I worked on a case together this past week. Why don't you give us the rundown on this couple that is just about to really embark on retirement, and what some of the issues that they had and how you helped them solve some of those problems?
Yeah, so we met with this really awesome couple. They did a lot of saving. They don't spend over their means, but their problem was they just didn't have a plan in place. They didn't have a plan when it came to what to do with their investments, so they sat in cash. They didn't have a plan for Social Security, so they didn't know what to choose. They didn't have a plan for the pension, so they didn't know what to choose. So now that, it's getting more real and they're looking to retire within the next, couple years, couple months, they really needed to sit down and talk to someone and get some help.
Yeah, that's a good point. And we talked about this earlier on the show today. It's not really just about the investments, right? There's so many other problems that need to be solved when you're putting together your financial plan. And for them specifically, some of the most critical income they were going to receive was Social Security and that pension. and there are a lot of different options. The pension, I think there was 10 different options on how they could take their pension.
Yeah, and if you have no one to talk to other than the other people who you work with, you're not really getting much help. No one's going to sit down and build out these numbers for you or really explain what these different options even mean at the company.
Yeah, exactly. I mean, that pension paperwork would make your head spin, if you didn't run, and we ran a pretty sophisticated spreadsheet to figure out the optimal time and way for, basically them to take their pension.
Yeah, so we ended up being able to pick out their pension. We were able to run the numbers and see what was the best time and the best way to pull their Social Security. And then we were able to walk through and find out why they've been in cash for all these years. What was the real fear behind it?
How many years have they been sitting in cash, Frankie?
At least 2, Bob.
Ooh.
Yeah, so they missed a big run. But in their mind, at least they weren't losing anything. But unfortunately, with inflation, they were losing.
Well, I like the way you did this, too, because we looked at, they want to retire very soon here. We know what their expenses look like. We figured out, here's when to take your pension. Here's when to take your Social Security. So we know what incomes are coming in. And then we looked at pretty much retirement for another 25, 30 years. And then we just showed them, look, if you sit in cash earning less than 1%, and we assume that the cost of living would average somewhere around 3%, because that's been the average since World War II, they actually run out of money because their money is not earning anything.
Exactly. And they didn't even need these wild returns. They didn't need these 10% returns to get them to their goals. They needed something like a 5% conservative portfolio. So we presented, a diversified portfolio, getting them some equities to help, break through inflation, but then really just getting them a very, investment grade bond portfolio with some stable income. And that set them for life. And then some.
Well, that's the beauty of the wealth projection, because here's something, as someone's entering retirement, they're smart enough to call us and come in and see you, Frankie, to have this analysis done. They might have gone 10 or 20 or 10 or 15 years in retirement thinking they're in great shape, only to find out in their 80s they're broke.
Yeah, and that's a tough conversation to have, to say, hey, look, but that's kind of the tough love, Frank, that I think you were able to bring to the table here. Is just realistically, based on all these numbers, you're going to run out of money.
I've been told I'm not as mean as Ryan, but I'm tough.
The velvet hammer.
The velvet hammer, I like that.
No, but absolutely. I think they just needed someone that they could trust. They needed a fiduciary that was going to work for them. They've been burned in the past with someone who wasn't a fiduciary. I think they were a little bit timid, so they thought, hey, you know what? Instead of losing, let's just be conservative. Let's stay in cash. Luckily, they heard us on the radio. They came on in, and we were able to have a good relationship. So.
Yeah, something else I would mention, too, because we're talking a lot about cash today, and this is why I really love our famous investment analysis spreadsheet, is we could basically estimate, here's the amount of income you're generating today with most of your money in cash, end up being like, I don't know, maybe $10,000 in income, versus just getting into a diversified portfolio that's very conservative, right? Because in this case, we don't need a lot of risk. And look, I don't know what the market's going to do next year. If I did, I'd be on my yacht. I wouldn't be here, no offense to you guys. But irrespective if the market goes up or down, we know with pretty much all the certainty in the world, just getting into our diversified portfolio, we were to bump the income up to $51,000 a year from less than 15. I mean, that's amazing. That's a huge number to generate an income, and it really is about generating income, especially as a retiree. Yeah,
it comes down to what is your fear? Is your greater fear volatility, or is your greater fear running out of money in retirement? So I think that I love about the wealth projection, it puts in writing and articulates those fears so you can make rational decisions and take the emotions out of it, and and help people to overcome that taking that first step. This is a lot of money they have. It doesn't have to be all put to work at one time. They can dollar cost average in, get comfortable with the idea. But once you have that written projection, it gives you a pretty good roadmap of what your financial life's going to look like for the next 10, 20, 30, even 40 years. But Frankie, the other thing that I noticed was that you didn't just analyze their portfolio. You also reviewed their estate plan. What were some of the pain points that you revealed there?
Oh, yeah, I'm glad you brought that up, Bob. The huge pain point. So they found out that the way that their will was written, God forbid, both of them are deceased, and one of their funds going 50-50 out to both their children. God forbid one of their children were to predecease, that money actually went to the surviving sibling rather than going to the deceased children's heirs, so their children, so the grandchildren. And they were really upset when they found out that's how their will was created, because they want to make sure that, their grandchildren are taken care of. Once they're not on God's green earth anymore, they want to make sure that their full family is taken care of.
And it's like a small thing that just needed one tweak. They call that what, per stirpes, Frankie?
Yeah, just a per stirpes clause. All they needed was a codicil to fix it. So just a quick amendment to the will. But it could have made a huge difference if, something were to happen.
Exactly. Well, having done personal estate planning a number of times, it can be exhausting. And at the end of the process, in a lot of cases, people just take those documents and lock them away and never think about it. So it's so critical, especially in this situation, that they had this reviewed to find out that there was a flaw in what the document said versus what their intentions were. So, I think it's one of the major reasons why everyone should take advantage of the offer that we make at No Payne No Gain.
Yeah, awesome job on this, Frank. And look, if you're sitting there right now thinking, okay, I need to get on top of all this stuff, let me find out, am I going to outlive my money, or is my money going to outlive me? Is my estate plan set up correctly? Am I generating enough income in retirement so I can live comfortably? Here's your shot to do it. We still have a couple slots left. If you give us a call, we will run our total financial master plan, and we'll do it with no obligation or cost, the full review. So if you bring in those estate docs, we have an estate planner that'll point out what you're missing, what needs to be updated in your estate plan. If you bring in your tax return, we'll look at taxes. We have a CPA that'll make sure you're not paying unnecessary taxes. And again, bring in all those statements. Wait till the end of the month. Bring them all in. Bring in a brown paper bag. We'll put it all together on a simple 3-page spreadsheet, and we'll look at everything. So we're going to look at cash flow, income. We can increase this couple's income by over $20,000 a year. Can you increase the income on your portfolio? We'll show you how to optimize that. We're going to look at diversification. What risk, what pitfalls do you have in your portfolio? We're going to point them out. Do you have bond funds? Do you need more safety? Do you need more income? We're going to look at it. And we're going to look at fees. Are you being overcharged on your investments? We're going to break down all the fees, including those hidden costs, so you know what it really is costing you to have your portfolio invested. Then we're going to tie it all together into one total financial master plan, and we'll determine, are you going to outlive your money, or is your money going to outlive you, using strategies now we've literally worked on for over 40 years to take your family from point A to point B with the least amount of risk and the highest odds of success.
So if you want to become a financial friend of Frankie, give us a call at 844-PLAN-NYC. That's 844-752-6692. If you're one of the next few callers and you've saved over $200,000 for your retirement, our team will run for you our total financial master plan. There's no obligation and there's no cost. All you have to do is call 844-PLAN-NYC. That's 844-752-6692.
Well, great show this morning, and I have to think after that review, Frank, everyone wants to be one of Frankie's financial friends.
It's an exclusive club.
Very exclusive club. Well, thanks for coming on the show this morning. Great job.
Thank you. Thanks for having me.
Big Bob, always a pleasure, my man.
Looking forward. All right, I tell you what, I can't wait till tomorrow because you get better looking every day.
That is honestly, that's the gospel right there. Well, listen, have a great weekend, and as always, be bullish.
Information provided on today's show is provided for information purposes only and does not constitute investment, tax, or legal advice. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with an investment, legal, or tax professional before taking any action.